I've tried every single strategy you can imagine, breakouts, trend lines, and even those shady strategies that you would see all over YouTube. And they cost me years to understand that most of them were noise. Most traders think that they can make money trading these BS trading strategies that they saw on TikTok or YouTube Shorts. And even though 80% of profitability comes from psychology, without the proper strategy, you're just gambling. And that's why in this video, I'll be ranking the 6 most common trading strategies to see whether they will make you money or make you lose it. I'll be grading each strategy from A to F tier based on real execution, and by the end of this video, you'll know the exact strategy that made me $10,000 in one single trade. For me to rank a trading strategy A tier, it must check these 3 things. The strategy must give me repeatable patterns that I can execute on over and over. Second, it must provide clean entries and exits. That means sniper entries with clear invalidation and realistic profit targets. Lastly, it must have either a high risk to reward or a high win rate. If the strategy offers a high RR, the win rate can be around 30 to 40%. But if the RR is below 3R, then the win rate must be above 50%. If it doesn't check those boxes, it's going straight to F tier. Let's start with the most common strategy that beginners fall for, and that is breakout trading. The idea behind it is straightforward. Entering a trade when price moves above resistance or below support, or simply when price breaks outside of a range. It seems simple, and that's exactly why it attracts beginners. Now let's see if breakout trading actually checks those 3 boxes. Breakout trading looks so perfect when you see it on the charts, but after execution, it's emotional and heavily manipulated. For repeatability, breakouts happen all the time, but most of them don't give solid results. Even when they do, you're reacting late by buying tops and selling bottoms. This gives us a huge stop loss, which you can reduce the risk by lowering the lot size. But because entries are late, it doesn't give a reasonable profit target, which means it doesn't check the box for clear entries and exit points. Since breakouts offer huge stop losses with low profit targets most of the time, the RR stays low. Because they're not repeatable, the win rate falls into the 25 to 30% range. So breakout trading is going to go straight to F tier. Alright, so let's move on to another strategy that looks clean on the charts. Trend lines are basically connecting highs and lows to define market structure. On a chart, they show you the direction the market might go. When the price respects the trend line, the market usually keeps moving in that direction. It makes perfect sense for projecting trends. The problem comes with execution. Trend lines are subjective. What looks like a perfect trend on one chart might be invalid sometimes. Even with trendline breakout trading, you're not going to see good market movements. That's why repeatability is a big issue. Most entries happen around the trend line touch point when it breaks the trend line, signaling a structure shift. Sure, it gives a solid take profit level, but the risk to reward often ends up low because it's hard to place your stop loss perfectly under a trend line. Even if there's a wick out, trends can still be valid. Only considered broken when there's real momentum break or a candle that closes beyond the trend line. So it might take us out immediately, but here's the thing. If a key level lines up with the trend line, you can actually get a reasonable place for your stop loss. The reality, trend lines usually sit around 45 to 50% win rate. Even with low risk to reward, you might actually see decent results, but because price doesn't always reach the full target, I'd rate trend lines as a C tier strategy. Next, let's move on to Fibonacci retracement, which honestly looks super professional, but not as it seems. Fibonacci retracement is used to spot pullbacks before price continues in the same direction. It helps identify hidden key levels and shows you the premium and discount zones. Using it is simple. You draw from a swing high to a swing low and watch how price reacts to the key percentage levels, mostly 23.6%, 38.2%, 50%, 61.8%, the golden zone, and 78.6%. These levels are often used to place trades, set stop losses, and determine profit targets. Even if you correctly identify the market structure and mark out the valid highs and lows, Fibonacci doesn't always respect the law of liquidity. In other words, while it's easy to use just dragging from the swing high to the swing low, most of the time it doesn't work perfectly. For entries and exits, most traders base their trades directly on Fibonacci levels, not on actual key levels, so they usually don't give a true sniper entry. Targets often sit around swing points and stops are usually placed around the same way. Sniper entries are crucial in trading, but they are not a must thing. So on that front, we can check the box for entries and exit points. Risk to reward can be decent, but the win rate is inconsistent. Overall, I'd put Fibonacci retracement in the C tier, but since it's a perfect tool for spotting premium and discount zones, I'm bumping it up to a C+. Let's switch gears to a trading strategy that many claim to have made them millions. Support and resistance. Support and resistance are levels where price tends to pull back when it reaches key points. Think of them as horizontal lines that shows when price reacts. Support is the level where the downtrend market rejects and bounces back. It's basically the floor of the market. Resistance is the opposite. It's where an uptrending market gets rejected and pulls back, acting as the ceiling. On the surface, support and resistance might seem basic, but in practice, it's surprisingly effective. Repeatability is strong if you use higher timeframes, giving you consistent trading opportunities. Even if a key level gets broken, the level can still be valid. Support often turns into resistance, and resistance can turn into support. If you're patient and wait for a proper pullback, they're still tradable. But the harder thing is to identify liquidity. Even the perfect support and resistance level might get wicked out, or price might pull back without hitting your target. I was about to check repeatability, but for this reason, we'll leave it unchecked. Entries are clear when price reacts properly. Invalidation points are well defined, and profit targets are realistic. This checks all the boxes for clear entries and exits. With proper execution, both the risk to reward and win rate can be strong. Even as an average support and resistance trader, you can still hit around a 40 to 60% win rate with a good risk to reward. Since it works best on higher timeframes, it's not ideal for scalpers. To be patient, and as basic as it seems, it actually takes pretty long to master. Overall, support and resistance earns a solid spot as a B-tier strategy. Now let's move into a strategy that's very well known in the trading industry: order blocks. Order blocks are areas where large institutional orders previously moved the market. They form the first candle after a swing low or a swing high. But here's the rule most people ignore. For a order block to be valid, a fair value gap must form after. If there is no fair value gap, it's not a high probability area to use as an entry. Now here's the problem with order blocks in today's market. Most of the time, order blocks don't get respected anymore. Why? Because fair value gaps are the real key areas now. What usually happens is price respects the fair value gap and leaves the order block completely unmitigated. So yes, order blocks used to work, they were repeatable, they were reliable, but right now, not really. In current market conditions, they're not really effective. For entries and exits, order blocks are known for very tight stop losses and potentially huge profit targets. Sounds good on paper, but in reality, what happens most is price often reverses, takes your stop loss, and then moves toward the original target without you. And you can't easily target another order block either, because order blocks form at swing points, which usually puts them awkwardly in the middle. Ideal for clean entries, but not for clean targets. Yes, they offer tight stop losses, but when we look at the win rate today, they simply don't perform like they used to. Because of that, order blocks are going into the D- tier. Supply and demand are also the same thing, so they're going to the D- tier as well. But if order blocks don't work because of fair value gaps, how well do fair value gaps actually work? We're going to find out. A fair value gap is created when the market moves too fast, leaving behind an imbalance between buyers and sellers. In simple terms, it's an area where price did not trade efficiently. The imbalance between the high of the first candle and the low of the third candle, or vice versa, is the fair value gap. If there is no gap, there is no fair value gap. To market for a bullish fair value gap, you draw from the high of the first candle to the low of the third candle. And for a bearish fair value gap, you draw from the low of the first candle to the high of the third candle. That box you draw is the fair value gap. Fair value gaps are important because the market naturally returns to areas of imbalance and rebalance price, which is why, instead of respecting order blocks, the market now respects fair value gaps first. Most of the time, price displaces, which pulls back into the fair value gap and continues in the same direction, which is why fair value gaps offer cleaner entries, more consistent reactions, and better repeatability in current market conditions. When a fair value gap gets broken, it's still valid because price often retests it as a support or resistance, creating a clean market structure shift. And this is called an IFVG. I've explained IFVGs in another video. Between FVGs and IFVGs, both are repeatable if you use proper confirmation, although I personally lean towards IFVGs because regular FVGs don't always give solid results. Both use liquidity targeting for entries and exits, which gives clean executions, and while they don't always offer tight stop losses, they commonly sit around a 1-to-1 risk to reward. Although I've personally achieved a 1-to-5 and even higher RR trading fair value gaps with my trading community, which by the way will be linked in the description. In terms of win rate, FVGs are slightly lower than IFVGs, and I've managed around an 85% win rate over the past 2 years, but it took years to master, so don't expect results immediately. Because of that, FVGs go into A tier and IFVGs are going into the A+ tier. Now, which strategy would go into the S tier? If I had to crown the best strategy, it would be IFVGs because they offer sniper entries, clean invalidation, and realistic targets, and a high win rate compared to FVGs, which I talked about in detail on the video as well. While the worst strategy by far is breakout trading, because come on, you're trading against institutions that have more tools and information than you, so don't expect this strategy to save you. If you want more on IFVGs, make sure you join my free Telegram and trade with me live on Asia session, which is completely free. And make sure you watch this video next because it's going to explain a lot more about the trading strategies that I covered in this video.